If you've been an AT&T investor over the past few years, it's been rough. Like, really rough. What's up? I'm Russ, and I'm an AT&T investor who's thinking about getting out of the telecoms. And I'd love to hear your thoughts, and if you're impressed by what I have to say, please light up that sub button. If you could travel back in time to August 1st, 1995 to be exact, and invest $10,000 into AT&T or the S&P 500 and reinvest all dividends, as of this recording, you'd be $94,467.92 further ahead had you picked the S&P 500. And check out this 10-year total return chart from Seeking Alpha comparing AT&T, Verizon, T-Mobile, and the S&P 500. T-Mobile is up almost 700% compared to AT&T at 34%, Verizon at 45%, and even boring old S&P 500 is cleaning their clocks, which is up 165%. Now, I've been invested in AT&T off and on since 2018, and as of this recording, I'm down 17% averaged across 3 portfolios. So you might be thinking,
should I buy more AT&T?
Should I sell my T?
Should I wait for the shares to pop, then drop the position? I don't know about you, but I've always heard about what a great investment AT&T and Verizon are, and any serious dividend investor should have them in their portfolio. I mean, even Coca-Cola and PepsiCo have had total returns of over 1,000% going back to February of 1993. And going back again to August of 1995 and comparing AT&T and Coca-Cola, even if you had pocketed all those dividends, you'd have received an extra $12.32 in dividends per share with AT&T. But you'd be 353% per share further behind Coca-Cola. Now, I think that's no bueno for a few extra bucks of dividends per share. Dude, I'm doing a video. Come on, man. So part of the reason for AT&T and Verizon's lackluster performance is that being in the telecommunications industry is pretty capital intensive. These companies provide things like phone and internet services, and to offer these services, they need a lot of big, expensive things like towers and underground wires. So building and keeping all these things working is very costly, and it takes a lot of money to do it, which is why investing in these companies is considered to be capital intensive. Last year, AT&T spent $19.6 billion on acquiring or upgrading long-term assets such as property, equipment, or infrastructure, and expects the same capital expenditure levels in 2023. But 22 and 23 are ballooned capex years, where AT&T projects 2024 being a return to normal, which should equal higher profit margins. And remember, since stocks follow earnings, longtime shareholders could have to wait until 2024 for an opportunity to exit the position with a profit. Now, I also like that they're paying down debt. In 2022, AT&T spent $43.4 billion paying down both long and short-term debt, which was good for a net debt reduction of about $24 billion. This leaves them with $135.9 billion of short and long-term debt. Now, I know this seems like a lot of debt, and it is, but there's something I want to point out. They have debt structured all the way out until July 15th of 2097, 74 years away. So servicing their debt really shouldn't be too much of an issue. But as they say, all debt will eventually have to be paid back. AT&T will also be bidding for and hopefully seeing a flow of federal government funds by contracting work through the $42 billion Broadband Equity Access and Deployment, or BEAD, program, which seeks to achieve a better connected America. Now, it'll be seen how much work that they generate from the BEAD program, but it could have a positive impact on the bottom line for the next few years to come. Simply Safe Dividends gives AT&T a dividend safety score of 70. They have a current yield of 5.45%. And of course, there's that dividend reduction, which was more of a right sizing from the Warner Brothers Discovery spinoff. And as of this recording, they're going to be looking for their first dividend increase sometime in the spring of 2023. But they're currently paying $1.11 per share, or 27.75 cents per quarter. Now, their dividend yield is about 17% below their their 5-year average. And their free cash flow payout ratio, while at 64%, could be a little bit better, so I'd like to see that coming down. But as of right now, there's really no issues with them paying that dividend. As remember, the dividend is $1.11 per share, and they're currently bringing in $1.73 of free cash flow to the bottom line. And what do we do with free cash flow? You can either pay the dividend, you can buy back shares, you can pay down debt, or you can carry it as cash on the balance sheet. But their sales growth, negative 28%, looks a little bit yucky right now. They have 7.17 billion shares outstanding. Only a 7% return on invested capital, not very good. Net debt currently at 59%, so that's right at the borderline safe area. And their interest coverage ratio, how much operating income do they have to cover every $1 of interest expense? Currently $3.75. We'd like to see that number at least over 5. Popping on over to alpha spread. T gets an intrinsic valuation in the base case where everything's just flat for the next 5 years, $29.98, making it about 33% undervalued. But if we look at the bear case, 5 years of negative growth, we see an intrinsic valuation of $18.58. And remember, there is no specific intrinsic valuation number. It's a guess and it's a range. It's like knowing somebody needs to lose weight without knowing exactly how much they weigh. And we can look at the competitive landscape for AT&T and see most of the sector are indeed undervalued. And as for ownership, there have been, according to this, no buys or sells in the last 12 months. I think there are much better options out there in the marketplace, and as for me, I'd feel much more comfortable buying SCHD for the stability and diversity of the companies that are within, and also in the telecom space, it's really capital intensive and it's really highly competitive. So check this out. SCHD was created on October 20th, 2011. So if we do a dividends reinvested comparison starting on Halloween of 2011, you'd be almost 250% further ahead by investing in SCHD. And again, as things are, I'm down about 17%. So for a slight profit, I'm going to need about a 20% gain from AT&T from here. So in my opinion, I think it might not be until 2024 that we see CapEx normalize and AT&T really starts reaping the rewards of its latest bout of modernization and upgrades to their network, which will push their profit margins higher. And we all know that stocks again follow earnings, which should bring their share price up. So until then, I'm going to keep my fingers, toes, and eyes crossed and collect the dividends until I can get out of AT&T with a profit. I'd love to know what you're doing with AT&T stock or Verizon stock for that matter. And while we talked about SCHD being great and all, it's missing a sector that's pretty popular with dividend investors. So if you would like to know what SCHD is missing, smash the thumbs up button, click the little box floating next to my head, and if you do that, I will see you there.